Hello class, welcome to lesson 2 of professional practice. Today we will start looking at the topic of insurance. We'll be looking at types of general insurance that are applicable to the building industry, and we will specifically look at fire insurance and its application. Okay, so here we will be looking at the types of insurance necessary during contract and the fire insurance. Okay, so what is insurance? Here we will be asking a few important questions. What is insurance? Why is it necessary? What are the basic principles of law in insurance? What are specialized forms of insurance which are used in property insurance? How does fire insurance work? And what are the conditions for a claim to be reimbursed under fire insurance? So to give you a basic introduction, the idea of insurance is not something which sprung up as a part of the modern world. It has always been there as a informal method of pooling in a certain amount of money, which would serve as a corpus for any untoward emergency or an expense which you expect somewhere in the future. All right. Now, in a traditional sense, the most significant expense that a person would incur would be the expense towards a marriage or expense towards medical treatment, something of that sort. Okay. So, in such cases, what would happen is that a group of people in a particular community would come together, aggregate their money, and create something which is a corpus of funds through a regular contribution on a monthly basis. Okay. Now, this corpus of funds is available to any person of the community who has been contributing to it, any family. All right. Now, once they borrow a certain amount of money from it, over a progressive period of time, they have to repay the amount of money that they have taken from it. Right. So the idea is basically to keep a certain amount of money ready in the case of particular emergencies. So this largely helps on a community method. The idea of modern insurance is pretty much the same thing, just that we are not looking at it from a community basis. We are looking at it from an individual basis. Here, in the case of insurance, we don't necessarily know who else in the entire network has opted for the same kind of insurance, has opted for the same kind or same policy, and has the same kinds of requirements. Okay, and who's paying what kind of money towards their premiums. So a chit fund works basically on the idea of individuals of small community pulling in a certain amount of money over a previously agreed duration to create a large corpus which can be dipped into by any member of the community at a time of need. Again, we discussed that these kinds of needs were much simpler when it came to older communities. The concept of insurance is a modern iteration of the idea of chit funds, which are still prevalent in the rural regions of the country. So here we start talking about insurance in its purest manner. Basically, insurance is a contract which is represented by a policy, in which an individual or an entity or a group, which we call as an insured, receives financial protection or reimbursement against losses from an insurance company. It's called the insurer. Okay. So the key point that we have to keep in mind over here is that the idea of insurance is a contract. A contract is basically an agreement, a gentleman's agreement between two parties. And we've already talked about contracts in the first cycle of your professional practice, right? So if insurance is a contract represented by a policy. We have one person promising another person a certain activity, which is again what we understand a contract to be. In this case, the insurer, who is an insurance company, offers financial protection or reimbursement against a loss which may be incurred by an individual or an entity. Okay? So, the company pools clients' risks to make premium payments more affordable to the insured. Now, the idea over here is that certain things are considered certain things are considered as individually applicable, but there is a certain range within which you have to make payments, which are insurance premiums, which allow to create a large corpus of money. All right. Now, let us say, for example, over here, a group of around 1,000 individuals take out insurance premiums, take out insurance policies, and pay a premium of around 100 rupees per person. Okay. So, a group of 1,000 individuals and 100 rupees per month per annum. Okay. 100 rupees per month. So, if it is 100 rupees per month for 12 months, that's around 1,200 rupees per individual into 1,000 individuals. So that is a corpus of nearly 12 lakhs, which can be created for a particular corpus. Okay. Now, 12, 12 lakhs can be considered as the amount of money that you can gather from a group, a community size of around 1,000. Now, the terms of an insurance contract is that it has to be these payments have to be made regularly for a period of, let's say, around 10 years. So 12 lakhs over 10 years. How much does that come to? 1.2 crores. Okay. Now, within that particular period of time, let's say a person has insured his life for around 25 lakhs in the case of his untimely death, and that person passes away. Now, out of a corpus of 1.2 crores, is it not possible that a certain amount of money, around 25 lakhs, can be set aside as a reimbursement for the insured? It is possible, right? So we are creating a corpus over here, which over a prolonged period of time is supposed to give us this amount of money. And once that amount of money is achieved, and let's say in the middle of that somebody unexpectedly expires, that person can be reimbursed for that particular amount, let's say 25 lakhs. All right. Now, again, these are very, iffy figures. We are talking about something which maybe even lesser than this. And I'm giving you a general idea of what the idea of insurance is. Okay. Losses that are generally described over here are, at least over here, in the case of property insurance, are destruction or invalidation of assets by any accident of any event. So you have fire, we have floods, cyclone, lightning, earthquake. These events are termed as perils, and there is uncertainty about the risk of their occurrence. All right. It is not necessary that you are going to always have a fire, you're always going to have a flood, you're always going to have a cyclone, or there is going to be an earthquake. These are perils which may or may not happen. Okay. But there is an uncertainty about the risk of their occurrence. And these kinds of uncertainties are decided upon based on the location of the property, location of the asset, all right, and how vulnerable it is to damage to any of these causes. Okay. Moving on. We have a few basic definitions that we have to keep in mind when we are talking about insurance. The first one is valuation. It is basically the assessment and assignment of monetary value to a particular asset. This is known as the insurance value. And it may further be subcategorized as two different values at the time of insurance. One is the reinstatement value, which represents the present day reimbursement cost, replacement cost, and the market value, which is arrived at by deducting depreciation from the reinstatement value. It can be considered as the actual worth of any property at any given point of time. So, to give you a clear definition of it is, reinstatement value basically takes into consideration the amount of money it will take for you to directly replace an item which has been lost, destroyed, or depreciated. Okay, which has been destroyed by whatever reasons it may be. It talks exclusively about rebuilding the entire structure. Okay, and it does not take into consideration how much the structure has depreciated in terms of its value. Okay, now market value is basically derived at by deducting depreciation. Depreciation is again something which you will start looking at a little further on. The next few lessons will be about depreciation, and the idea of depreciation is basically to assess how much a property has degraded in value. Okay, value is basically what you are willing to pay for a particular property or for a particular asset. Market value is determined by deducting depreciation from this reinstatement value, the cost that is incurred in terms of replacing a particular asset. Okay, I hope that is clear right now. Subrogation is defined as the transfer of rights and remedies of the insurer to the insured, who has indemnified the insured in respect of the loss. This basically means that the insurer is empowered by language present in the policy to recover costs incurred in indemnifying the loss from the third party responsible for causing the loss. Okay, to give you a simple understanding of this example over here, we'll talk about it with regards to vehicular insurance. Okay, now you are traveling on the road and you are involved in a road accident where somebody else is the person who is found out to be at fault. Okay, so how does the insurance claim process work over here? So if there is a third party responsible for causing the loss, what happens is that your insurance company, basically the company that covers any damage that occurs to your car, will directly reimburse you based on the evidence of whatever has been detected at the time of the incident. They will directly cover you. Indemnifying your loss is basically where the company says that you have suffered a loss, but I will take on the responsibility of replacing your loss. Okay, that is the idea of indemnification over here. So a company says that it will cover your losses and directly reimburse your money. And then after that, the company is empowered to go after the third party who's responsible for causing these losses. Okay, so when I say go after over here, it does not mean that they will sue them in court or anything of that sort. Ideally speaking, when the third party, the person who has caused the accident, he will also have an insurance. And what happens is that your insurance company can demand the money from his insurance company, and his insurance company will deduct it in terms of his insurable value for his car, in terms of increasing his payment premiums, so on and so forth. So the idea of subrogation is that your insurance company, the company who is indemnifying your loss, can recover the costs of indemnification from the party who caused the loss. I hope that is clear so far. Contribution is defined as the right of the insurers who have paid for the loss under a policy to recover a proportionate amount from other insurers who are liable for the same loss. This occurs when a person may have several insurances on the same subject matter. Now, let's say for example, a farmer decides that he has to insure his property against losses due to a bad crop yield. He decides to insure it from the cooperative bank, then a private insurer, so on and so forth. Now, it is important that the farmer informs each one of these companies that, yeah, I have the same property and I'm insuring it under these heads. Okay. Now, the reason why people will do that is that they expect slightly better returns from some one place or the other. Okay. Now, contribution is where these insurance companies, they network with each other and they find out exactly how much they have each insured this property for. And based upon their contribution, they can decide how much to reimburse the farmer. So let us say a farmer has a property which is worth around 15 lakhs and insures it under 4 different companies at different kinds of valuations. So the valuation can be that either the companies can choose to equally reimburse the farmer, or they can choose to have a certain proportional reimbursement. Okay. So the basic principles of general insurance that we have here are 4. Okay. The first one is known as utmost good faith. In this, the proposer or the person who is about to take an insurance policy has a legal duty to disclose all material information about the subject matter of insurance to the insurer. Material information is that which enables the insurers to decide whether to accept the risk, and if it is acceptable, what the premium should be. This applies not only to material facts which the proposer knows, but also to material facts which are contingent to very special circumstances. Okay. Now, to give you a simple example for this, if you are taking a life insurance policy, and if you are a smoker or you've had a history of smoking, there is a clause over there which tells you that you have to disclose how much you've been, whether you're a chain smoker or whether you're an incidental smoker, or how many years it has been since you have quit smoking. This is basically to find out exactly what kind of a risk it is to insure you for lung diseases. Okay. So in the case of subject matter of insurance over here, it is your life insurance. So in such cases, the company can choose whether or not to insure you against your loss of life due to reasons related to lung issues. If you are a smoker, you are considered a high risk, and therefore the insurance company can say that no, he's a smoker. He died because of either lung cancer or emphysema, whatever it is, and it can decide to reject taking up that risk. I hope I have made myself clear here. Okay. In the case of property, what happens is that the proposer has to be aware of the natural conditions, the physical condition of buildings around him, and where his building sits, so on and so forth, before approaching a company for insurance. Now, so let us say that a proposer has built a house, let's say within 15 meters of a lake. Okay. And he decides to go to the insurer to insure his house. Now, as per the BBM, as per the corporation limits, as per the corporation bylaws, it is illegal. There should be no development within a 30-meter buffer of lake regions. So automatically, what happens is that the the proposal gets rejected on the basis that the risk is almost 100% upon the insurer, the company which is doing the insurance. So it is almost certain, it is almost guaranteed that the proposer is going to lose his property, and it is not considered as a viable risk for the insurance company, and therefore they will reject it. Then again, there are other cases over here where you have a proposer. Let's say if a proposer decides to build something in a region in Bhuj. Okay. Now, Bhuj, as you well remember, was the place where there was a very severe earthquake in the year 2001. Okay. But after 2001, there have been absolutely no issues of that sort. Okay. Even though Gujarat at that region lies over a fault line in the Earth's crust. So in this case, we take contingent information over a prolonged period of time to see whether or not the risk is acceptable. Okay, so from 2001 to 2021, there have been no earthquake events no significant earthquake events in Bhuj. So it makes a reasonable risk to insure a property which has been constructed in the region of Bhuj. Okay, so this is how utmost good faith works. The proposer will reveal all of the information that is absolutely necessary for the insurer to make the right call. The insurable interest. The owner of a property has a right to effect insurance on the property if he or she is likely to suffer financially when the property is lost or damaged. This legal right to insure is called as insurable interest. Okay. So basically, it means that a person who has a vested interest or stands to gain financially from the continued functioning of a property and is likely to suffer very severely in terms of finance, this person has something which is known as an insurable interest. Okay. I recently came upon an article where we talked about horse racing. All right. In horse racing, it is almost a commonplace practice to insure your horses against loss. Now, why does this happen? Because if a horse gets injured during the time of a race or during its studding or whatever it is, the horse cannot be put out to race, and even if it does race, it will not necessarily come up with the same kinds of returns. So generally what happens is that the horse is put to sleep. Okay. And if the horse is put to sleep, what happens is that the horse owner suffers financially because it is his property which is lost. Okay. Again, it's a very aberrant term over here. Horse racing, I don't generally like it. But again, as an example for you to understand it, this is how it works. Indemnity. Again, we talked about indemnity a little earlier. The objective of this principle is to place the insured after a loss in the same financial position as far as possible as he occupied immediately before the loss. So this the idea of indemnity, it basically prevents a person who has insured himself from any kinds of losses. It stops him from making a profit because of the loss that is suffered as a part of this accident. Okay, the measure of indemnity as applied to buildings is the cost of reinstating the building or repairing the damaged portion minus the depreciation. Okay, we talked about this earlier over there, insurable value, correct? Indemnity is also a very important clause which comes into play over here when we talk about insurance fraud. Okay, insurance fraud basically is where you take out an insurance policy and you you decide to let a building rot, or you decide to let a building fall to disrepair because you are not making regular enough investments into it, then you decide that, okay, fine, I will gut the building and then make a profit from the insurance and rebuild the entire structure. Okay, so indemnity stops people from getting away with willfully letting buildings go to disrepair. Okay. Proximate clause. Insurance provides financial protection for losses caused against any of these insured perils. If the loss is due to two or more causes acting simultaneously or one after the other, then it is essential to identify the most important, the most effective, and the most powerful cause for responsible for the loss. This clause is termed as the proximate clause, and all others closest are considered as remote. Now, again, we will take the example of the 2001 Bhuj earthquake. Okay, so several buildings were destroyed and subsequently they caught fire. Okay, now in such cases, what happens is that the first proximate clause is considered to be earthquake. There are two causes of damage of property over here. You have one which is earthquake and one which is fire. Okay, the earthquake comes as the most important and the most effective and most powerful cause over here. Okay, and that damage is considered primarily in terms of loss reimbursement. Okay, fire is a secondary is a cause of secondary loss. Okay, damages which are caused by fire are considered as remote and will not necessarily be reimbursed in this particular example. Okay, I hope I have been clear with regards to the basic principles of general insurance. So there are specialized forms of property insurance here. We talk about fire insurance, which is basically a contract of indemnity under which an insurer, in lieu of a premium paid, agrees to cover for financial losses caused to a property due to fire for a specific period of time and up to an agreed amount. Now, the highlighted terms over here are the ones which you have to very clearly keep in mind when you are trying to define insurance. Okay, so when you're talking about fire insurance over here, it's a contract of indemnity and it covers financial losses due to fire up for a specified period of time only and up to an agreed amount only. Okay. Fire insurance policies can only be transferred from one party to another with the consent of the insurer. So basically, it is basically like your any document for that matter. You cannot transfer your passport to somebody else. You cannot transfer your ration card to somebody else until you have the consent of the party which has issued the contract. Okay. So, building, electrical installations, goods, machinery, furniture are some of the items which are generally insured under a fire insurance policy. Okay, so these are the physical aspects of it. Now, the aspects which are covered under fire insurance, the kind of human action or the kind of damage that is caused under which is covered under fire insurance are as below. Okay, you have loss caused by the effort to extinguish fire. Basically, either increasing dampness causing an entire portion of the wall to collapse and crumble. That can because of the water that is used to extinguish the fire. Again, damage caused by the use of water to extinguish fire. If you are forced to pull down adjacent buildings to prevent the spread of fire, that is also considered as a part of losses and damage which can be covered. Damage to goods, which in the process of their removal from the building, that also can be considered as things which can be insured. All right. And wages which are paid to the workmen who are involved in extinguishing the fire. All right. These are the five things which are categorically covered as a part of the fire insurance. Now, what are the conditions that have to be satisfied for a claim to be accepted? Firstly, you have to give notice of the loss or the damage to the insurer. Then you should submit a claim statement within 15 days or the permissible time which is mentioned as a part of the policy document. Suitable deductions should be made for depreciation under insurance and salvage value. Okay. So deductions under salvage value basically means those things which you have saved from the building and set aside and allowed to be not destroyed completely. Okay. Whatever you can salvage after the destruction. Particulars of other insurers, again, we talked about contribution over here. That has to be decided, that has to be found out. Then expenses which are incurred on professionals, basically architects, surveyors, consultant engineers, to be capped up to 3%. Okay. So 3% of the sum insured will be the amount to which you'll be reimbursed for architects, surveyors, and consultant engineers. Expenses on debris removal limited to 1%, over and above the amount for which you have been insured. And in the case of fire insurance, the primary or the proximate cause of destruction should be fire. Okay. Fire must be accidental. Claims for goods subject to damage from arson will be rejected and the claimant will be liable for criminal proceedings. Arson is the act of criminally damaging property by setting it to fire. Okay. And these claims are generally, when you are submitting a claim for fire insurance, what happens is that you have the architect, surveyors, and consultant engineers who will come and examine exactly what the reason was for what was the cause of the fire. Okay. And based upon that, they will give you if it is an accidental fire, the claim will be processed. In the case of noticeable criminal mischief, the claim will be rejected and the claimant will be subject for criminal proceedings. Okay. The loss or the damage must relate to the subject matter of the policy. Now, this I think you guys are very familiar with the line. Insurance is the subject matter of the policy, so on and so forth, right? And here, in terms of fire insurance, it is very critical that whatever item you are saying has been lost or has been damaged due to the fire is covered as a part of the subject matter of the policy. So, in the case, to give you an example over here, if you have a house and you say that you have covered the entire house in a fire insurance policy, but you may not have covered a few books or let's say some of the other electronic goods inside the house, then what happens is that while your house will be reimbursed for, your books will not, your electronic gadgets will not, so on and so forth. You get the idea, right? So basically at the end of it, what happens is that you will have you will have the entire building and you will not have the um, furniture or the books which you need for the purpose of filling in the house. Okay. All right, just a moment. So Types of fire insurance policies. Here you have the standard fire and special perils policy. Covers damage from fire caused by fire, lightning, explosion, implosion, aircraft damage, riot, strikes. Also, malicious and terrorist damage, inclement weather damage, subsidence and landslide, flooding due to dam overflow, cloudburst, and bushfires. Okay. So again, if you consider these things over here, these are all considered as special perils over here. Malicious and terrorism damage it's a very special peril, and it is of critical importance in, let's say, cities like Mumbai, which have been so susceptible to multiple terrorist attacks. All right. Inclement weather damage is applicable to places which are heavily cyclone or hurricane prone. Okay. Subsidence and landslide. Subsidence is basically the sinking of your building. Subsidence and landslide is generally offered to these kinds of insurances are given to people who have properties in mountainous regions. Flooding due to dam overflow, again, for people living close to reservoirs. Bushfires for people living out in plateaued areas or places which have brush forests. Okay. Valued policy. Now, this covers properties whose market value cannot be ascertained. So, you have the example of curios, works of art, manuscripts, obsolete machinery, vintage automobiles, and similar things. Okay. So, in such cases, what happens is that the valuation certificate by a registered valuer shall be provided and should be acceptable to the insurer. And only in such cases is it possible for the insured to recover the money which has been for which it has been insured. Okay. In the case of an average policy, the use of this is basically where you are undervaluing the property. All right. And because of that, what happens is that the liability of the insurer is limited to the sum insured into the claim for actual loss and the value of the property. Okay. So the sum insured is basically the undervalued sum for which the property has been insured. So let us say, for example, over here, if it is around 4 lakhs, okay, and the claim for actual loss, over here comes to around 1 or 2 lakhs over here, and the actual value of the property is around 6 lakhs. So what happens here is that 4 into 2, 8 divided by 6 lakhs over here. That is the amount which you will eventually end up getting as a part of an average policy. Okay. A reinstatement value policy. This basically covers cost of replacing or reinstating buildings, machinery, furniture, fixtures and fittings, subject to certain requirements which are being undertaken by the insured. Now, these requirements are basically those which we already talked about, that the person, the insured, is regularly undertaking maintenance work for the building and ensuring that there is no damage which has occurred because of a lack of maintenance, a lack of regular maintenance. Okay. Now we come to something which I think a lot of people would have faced in one way or the other. We talk about issues which are related to claims. Okay. So fire insurance premiums are fixed by the Tariff Advisory Committee. Now, fixed rates basically means that you cannot overvalue a particular property. Okay. Now, this problem occurs when we have, let's say, when we're talking about fire insurance for places which fall under the same bandwidth of commercial establishment or residential establishment, but have a notable difference in their values. Okay. Now, I cannot I cannot have different rates by the directive of the tariff advisory committee. I cannot have different rates of insurance premium for, let's say, a commercial establishment, a commercial hotel establishment like a Darshini, and a hotel establishment like a brew pub. All right. The fixed fire insurance premiums are identical for both of these kinds of establishments. Now, they can be either too little, which means that there will be way too less in case there is a fire breaking out in the brew pub, or the premiums may be too high for the place which is as small as a Darshini. All right. So that is how the fire insurance premiums can be a problem. Again, it is a contract of indemnity, and the insured cannot claim anything more than the actual loss and damage. So whatever is exactly lost as a reason as a result of the fire will be exactly and verbatim replaced as a part of this contract of indemnity. Okay, the following are excluded from fire insurance claims: loss by theft during occurrence of fire. So let us say that your building is burning, and all of a sudden one fellow decides to jump in, steal something. Or let us say that the firefighters, touch wood, they should not do that, but still the firefighter decides to steal something from your place. Such loss is not covered by during the occurrence of fire. Okay. Subterranean fire. These are basically fires which occur in lower regions of the building. Now, most fire insurance policies, they cover only the superstructure, not the substructure. So if there is a fire which occurs in your basement, then this will not be included as a part of your claims. Okay. Burning of a property by public authority. Again, this we already talked about. The a public authority decides to, particularly demolish or destroy a building which is either violating something or has been completely condemned for a lack of safety. In such cases, you cannot claim for fire insurance. Okay. Effects of nuclear weapons and radioactivity cannot be claimed against. Stupid, yes, but such is the world. Okay. Electrical short circuits, which is quite ironic because most of the fire damage happens because of electrical short circuits. In the case of all insurance, salvage value is considered during the assessment of damages. If the quantum of reimbursement is under dispute, a provision exists for arbitration. If the claim is denied altogether, the insured should approach a court of law. Okay, so the clause of arbitration is something which we will discuss a little further. It's one of the other lessons that you will be dealing with in this semester. Okay, so if, let's say, the quantum of reimbursement, you have claimed for a certain amount, and the insurance company says that it is your claim is falsified and you're not going to get as much, you're going to get a fraction of what you have claimed, you can look at getting it arbitrated. If the claim is denied, you can approach a court of law and sue the company for a reimbursement. Okay, all claims have to be done within 12 months after the occurrence of loss or damages. So limitations for claims is 12 months. We already talked about something which is we talked about reporting a loss within 15 days or whatever period is stipulated. Now, the limitation of claims is basically for in 12 months occurs when you notice that there are damages over and above what you had already claimed. So you can make multiple claims. But within a period of 12 months. Okay. When a loss occurs, it is the legal duty of the insured to do his utmost to minimize the loss. So again, we talked earlier about maintenance of a building. Again, it comes down to the legal duty of the insured to minimize the loss. So minimizing the loss in the case of a building is to ensure that it is well maintained and does not suffer the kind of damages that may occur due to bad maintenance, fires, dis- um, uh, um, the building collapsing, so on and so forth, right? So this is the legal duty. If you let a building go to a state of dilapidation, the claims will not be entertained as readily. Okay, so that is it for the lesson of insurances, fire insurance and general insurances. So this lesson will be uploaded as a part of the YouTube, as a part of my YouTube channel. So please go through it, and I will be readying a session on Google Classrooms for you guys to answer any queries. Okay, it will open at 2:45 today, and it'll go until 3 o'clock. Okay, thank you very much. Thank you for logging on. I shall see you for the next session.